Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Bernoulli. Today we have a special treat for our listeners. It's a discussion on the principles of the Austrian School of Economics and how those principles can be used in investing. Today we have 5 panelists from around the world. Russ Lamberti from Cape Town, South Africa, Mark Valek from Liechtenstein, Chris Casey from Chicago, Bill Wagner from Dallas, and Mark Whitmore from Seattle. A bit of background on each. Chris Casey is the Managing Director of Winrock Wealth Management. He combines a degree in economics from the University of Illinois with a specialty in the Austrian School of Economics. He advises clients on their investment portfolios in today's world of significant economic and financial intervention. He's also written a number of publications on websites, including the Ludwig von Mises Institute, Zero Hedge, Family Business, Casey Research, and Laissez-Faire Books. And he's a board member of the Economics Development Council with the University of Illinois, a policy advisor for Heartland Institute's Center on Finance, Insurance, and Real Estate. Bill is principal and co-founder of Bearing Asset Management. He's a partner with Kevin Duffy to manage the Bearing Fund using an Austrian School of Economics lens in terms of identifying boom-bust cycles, value in the marketplace bubbles, and distortions created by both fiscal and monetary authorities. He's a graduate at the University of Florida, began his investment industry career in the late 1980s. Initially as a stockbroker and then moved to the buy side at Fidelity Investments. He's been featured also in Barron's, Reuters, CFA magazine. Russ Lamberti is the founder and chief strategist of ETM Macro Advisors, which provides macroeconomic intelligence and strategy services to asset managers, family offices, and high net worth individuals. He is the co-author of When Money Destroys Nations, a book about Zimbabwe's hyperinflation, and he is a contributing author at the Mises.org Institute. Mark Valek is partner investment manager of Incrementum. He's a chartered alternative investment analyst and has studied business administration and finance at the Vienna University of Economics. From 1999, he worked at Raiffeisen Zentralbank as an intern in the equity trading division and at the private banking unit of Merrill Lynch in Vienna and Frankfurt. 2002, he joined Raiffeisen Capital Management. In 2014, he published a book on Austrian investing. He's one of the authors of Austrian School for Investors. And Mark Whitmore is Principal Chief Executive Officer of Whitmore Capital. He's been managing personal portfolio assets, periodically publishing newsletters, blogs, providing pro bono financial planning investment consulting since leaving law in 2002. His specialties are currencies and international economic analysis. He's obtained a BA in political studies from Gordon College, graduated summa cum laude, and at the University of Washington, he earned a master's in international studies at the Jackson School and a JD from the School of Law. Welcome, gentlemen.
Thanks for having us.
So I thought we'd have a discussion initially about what is exactly the Austrian School of Economics and how does this School of Economics differ from other schools such as the Keynesian School of Economics. Mark Valek, would you like to begin?
Oh, I'd love to. Thanks for having me. I'm very excited to discuss basically economic school, which is from Vienna, my hometown. Unfortunately, Vienna doesn't really teach, the University of Vienna doesn't really teach Austrian economics anymore. However, I think the topic of the Austrian school is a big one. One can talk for hours on end how it differs. We actually tried to to make the Austrian school to list the 11 or 10 bullet points. We came up with an 11th one, so we've got a slide. Austrian school in 11 bullet points, and this is by no means a complete observation, but just some basic concepts we took together. Just will refer to them. Economics is about behavior of individuals. It's basically about human action. Second point, human innovation and entrepreneurial action are the source of wealth creation. Private property is precondition for sensible resource allocation. Trading is mutually beneficial. Probably the interesting point is the subjective value theory of value. Another point would be underconsumption or savings is necessary for sound investing and growth. Also a very important, I think, point which differentiates the Austrian school is its view towards capital structure. So capital structure is key to a sustainable economy. Thinking about Hayek's triangle for the guys who knows what I'm talking about here. And price mechanism coordinates decentralized knowledge. So these were some basic concepts, and they are partly not only found in the Austrian school. Perhaps what does differ more is the view towards the monetary system. And I just will add 3 or 4 points regarding the Austrian view on the monetary system. Inflation, for instance, is defined as expansion of money supply. It's something very central to Austrian economists. Inflationary monetary systems chronically transfer wealth. I'm talking about the Cantillon effect, something I think the other schools really don't talk about at length, and it's something very interesting for society also these days. And finally, expanding money and credit supply causes the boom and bust cycle. It's also called the Austrian business cycle theory. So these are perhaps the more typically differentiating points, especially from the Austrians. But as I said, this list is by no means complete. Just a few thoughts perhaps to open up the discussion.
And Russ, your perspective on the Austrian School of Economics?
Yeah, well, everything Mark said is valid. I would, at a high level, I think that one of the key differentiators from a practical, analytical, and investment perspective is that the Austrian school draws a very straight and consistent line between microeconomics and macroeconomics. In fact, strictly speaking, the Austrians wouldn't differentiate between the two. Whereas what you see in Keynesian and even monetarist schools is, relatively sound microeconomic principles, although they do still differ with the Austrians in 1 or 2, key areas. But when they aggregate it up to the macro, a whole different theoretical framework is used, and there's essentially no consistency between neoclassical or Keynesian micro and macroeconomics. So there's a fundamental breakdown there. The Austrians are far more consistent there, and I think part of the essence of that is also that the Austrian school is derives its lineage from the classical schools of the 17 and 1800s. And I think we must never forget that, because a very, very key distinction in macroeconomics, a very key departure point between the different schools of thought is what's known as Say's law of markets. And Say's law, essentially, it's probably a poorly named concept, because Jean-Baptiste Say was not necessarily the best articulator of Say's law, but nonetheless, Say's law essentially says that properly allocated production that is sustainable is ultimately what what finances the ability to demand. And I think in today's macro world, it's only really the Austrians who are talking about the unsustainability of certain demand trends because of misallocated capital and misallocated productive resources. And that's, I think, why the Austrian business cycle is such a key distinguishing feature of the Austrian school.
And Chris, your thoughts?
Well, the Austrian school certainly has a number of conclusions and macroeconomic explanations that my colleagues have discussed. But if you boil it down and ask the true question as far as what makes Austrian economics different, I'm reminded of Ayn Rand, and when she was describing or criticizing, I should say, other philosophies and philosophers. And I remember her comment, I forget which writing it was something to the effect of, these philosophies have excluded man from their theories. And in so doing, it's no different than, let's say, an astrophysicist that has no concept of gravity, or a doctor that has no concept of germ theory. And the same could be said with other economic philosophies. Austrian economics is the only one that really puts man at the center of the discussion. It boils economics down to man in the context of nature as it relates to scarcity for his needs and wants. And in so doing, they then use a number of first principles that are build on from a deductive reasoning standpoint to create a consistent and sound economic school and economic philosophy. And that's what's really, I think, makes it different from the other economic schools out there. It's not just the conclusions, it's how we arrive at those conclusions.
And Bill, your perspective on the Austrian school?
Well, look, I think everyone here has covered quite a bit of the main points. I would add that the world that we're living in today, where we're very far from any Austrian practices, we have you cannot have a healthy economy without savings. And by artificially setting the interest rate through central banking, you set in motion numerous distortions. And I think everyone at this table would agree that we're living in a time where the distortions have never been greater. We have nothing resembling a natural rate anywhere around the world, as far as I know. And so what's happening is you're setting in motion, layers and layers of malinvestment. And then every time there's a crisis, in the Keynesian way of looking at things, they come to the rescue and try and either bail something out through monetary or fiscal policy and or socialize it directly or indirectly. And I would say we're living in a time today where so much of the credit expansion that we've witnessed, especially coming out of the great financial crisis in 2008, 2009, is a function of either zero or negative interest rates and or socializing some aspect of credit that's entered the economy. And when you have that, clearly there's no feedback loop. There's no clear natural feedback loop. You have a very distorted picture of things. And I think it's what makes today's investing environment so challenging.
And Mark Whitmore, your thoughts on the Austrian school?
Well, batting cleanup here is a little tough because, as Bill mentioned, I think that people have really nicely covered a lot of the main sort of theoretical tenets of Austrian economics. I guess I would add that specifically the role of central banking is something that I think is really distinct from an Austrian perspective versus Keynesian. Specifically, the asset price inflation that you've seen has largely been ignored consistently in the last two bubbles that now we're into a third bubble, I would argue as well. And essentially, the Fed and the Keynesians will continue to point to, well, there's really no headline inflation pressures, and hence there's really no reason to begin to normalize or adjust or move up interest rates. And I think that from an Austrian standpoint exacerbates this boom-bust cycle, which we've seen really compressed in terms of time versus what has historically been the case since maybe the mid to late 90s. And the amplitude of bubbles on the upside have just been far greater. And I guess I would just add, kind of Henry Hazlitt's kind of 2 points as far as critiques of Keynesianism. The first one being that what its fundamental flaws, I think, are one is it highlights and puts ahead of, in terms of interest, the visible minority at the cost of the invisible majority. And again, it gets to this whole issue of government being the problem solver, the one that can allocate assets essentially, in its view, most effectively from a Keynesian perspective in a countercyclical effective way, where I think Austrians are much more skeptical of the efficacy of that. And second of all, the propensity under Keynesian economics to overconsume in the present generation at the cost of creating massive debt for future generations to essentially somehow deal with it. We're certainly seeing that today in all developed markets across the world.
Great. Let's move to a discussion on how the Austrian School of Economics is helpful in understanding how and why the 2007-2008 financial crisis happened. And then sort of in parallel to that, what is the Austrian school saying today about the global economy? Are there any trends or outcomes that could be identified using the Austrian school? Just a general question, open to the floor. Anybody?
Well, this is Bill. I would say that, all of the Austrians, I'm sure, on this call saw the crisis building coming out of the reflation right after the tech bubble had burst. I mean, it was interesting. The internet created this initial innovation wave, decentralization wave, and of course, due to excess credit creation, money creation, you had a bubble and then a subsequent bust. And then instead of letting the system purge and to heal, the central banks led by the U.S. came in and lowered interest rates, and you segued from a technology bubble to a private sector credit bubble. And of course, I think it went longer than everyone on this call thought it would, and it eventually hit a wall and again tried to cleanse. And that was interesting. Yes, the central bank let certain groups fail, and then when things started to get out of hand, they stepped in and bailed out a number of politically connected constituents, and that then laid the foundation for this third bubble. And this third bubble has gone on longer than I ever imagined, or my business partner imagined that it could. I think the distortions are epic. I think we're living in a fascinating time. It's not going to end well. But I think along the way, there has been a continuation of decentralization, innovation. That's the positive that I think we're seeing today as well. But that's just the natural order of the entrepreneurs and the ecosystem thereof.
Yeah, this is Mark chiming in here. I would say that in terms of leading up to the 2007 crisis, I feel tremendously bad. Kurt Rickenbacker was, I think, a really fine economist, informed by sort of the Austrian school perspective, and he had done a great job identifying the perils of the tech bubble that I think Bill mentioned. A lot of us who are Austrian saw coming, and died right before basically the bursting of the second bubble. And what he had talked about is this notion of Ponzi finance that I think is a good analytical insight, that essentially, and Hayek talks about essentially the boom bust cycle is endogenous to the particular type of finance credit system you have in place. And as credit became increasingly untethered to any kind of historic connectors to things such as sound collateral and whatnot, you saw increasingly the signs of the economy going off the rails in the upward direction in a trajectory that was simply unsustainable. And so indeed that bubble went longer, I think that's right, than most of us expected. And this one is truly epic. There's one slide that I threw up which essentially overlays the S&P 500 with the growth of central bank assets in Japan, the Eurozone, and the United States. And it's, the the assets of the central banks that have been expanded is a little bit more jagged, but the curve or the direction and the amplitude of the line is almost exactly the same. And so you see this, again, unsustainable credit-fueled engine that's driving what's been taking place in terms of asset price inflation. It's just highly unstable. And again, this will not end well.
Yeah, it's Russell here, guys. I just wanted to chime in on what Bill had mentioned. I think it's really critical to look at this as three very big bubbles in a row, but also to think about the kind of compounding effects of repeated malinvestment that has been essentially disallowed from correcting and from reallocating properly. There's basically been since, I don't know for how long, maybe it was the Greenspan era that essentially ushered this in, but there's essentially a law, an unwritten law against recessions. And this is not just, a problem in America. This is a problem everywhere in the world. Politicians don't like recessions. As they push back through repeated cycles, we get a problem is basically of chronic malinvestment, chronically, poorly allocated capital. And this creates, half a working lifetime of living in an essentially very strange, unreal kind of financial and capital structure. But of course, as Bill rightly says, you have the countervailing forces of progress constantly working. The market is constantly trying to figure out how to make the best of its present reality and its present situations. And this is why I think you have kind of inherent paradoxes when you look at these big cycles, because there is so much to be bearish about, and yet there is also a lot to be bullish about. And I guess that's the essence and the nature of risk and opportunity. Mark Thornton once mentioned that Murray Rothbard used to say that he was permanently bearish about the short term and permanently bullish about the long term. And I think that it's a sort of an aphorism, but it kind of speaks to this notion that state intervention can really mess up markets and financial markets in the short term, but over time, the power of the free market and of private enterprise is extremely pervasive and eventually seems to win out at the end of the day. Of course, in the interim, what that means is that because you have such disinflationary forces because of private enterprise and technology, it kind of emboldens the policymakers to run these bubbles longer and larger than they should be. So no question that the last two bubbles have been a symptom of these kinds of policies, and I agree we're in a third very, very excessive state of distortion, and the best case scenario that we can hope for is a sharp, painful clear out of chronic malinvestment. That is the fastest path to genuine economic progress again. I hope we get there soon.
Richard, this is Chris. I'll just add that in discussing how Austrian economics explains the 2008 crisis and gives us some guidance as to future bubbles in economic recessions, it's worth recounting perhaps what does not explain the 2008 crisis, and that is mainstream economics, whether it's so-called Chicago or Keynesian schools. And it's probably worth remembering that in 2002 at Milton Friedman's, I believe his 90th birthday party, that Ben Bernanke stood up and literally apologized for the Great Depression and basically said, we're never going to have a significant recession again. I believe he even said something to the effect of, quote, we won't do it again. And so that tells you that central bankers pretty much around the world do not understand the causes of recession at its most fundamental level. They can't explain why it occurs. They can't explain why it's a cycle. They can't explain what Austrians call the cluster of error, why all these businesses have made horrendous investment decisions. They can't explain why every recession is preceded by monetary inflation. They can't explain why certain industries, capital goods industries, if you will, are far more cyclical than, say, consumer goods. So it's just something that cannot be explained. The Austrians do. And for the listeners who may not be all that familiar with the Austrian school, in short, whenever you inflate the money supply, you artificially decrease interest rates which distorts the whole structure of production. It forces economic actors to make investments they would not otherwise have done, that they would have otherwise deemed unprofitable. And it creates this malinvestment in the system. As my colleagues here today mentioned, we've already seen this play out twice in the last 20 years. And the response, if that's the causation of a recession, the response should be hands off. The response by the government and central banks should be, do not reinflate the money supply, do not create bailouts, which help these malinvestments linger on, do not have deficits, which only spur consumer spending at the expense of savings. So if that's the antidote to recessions, the government, since the '08 crisis, has done the exact opposite. And it's simply set up the economy for far, far greater downturn than what we even experienced then, with the possibility this time, I believe, with significant inflation. So it's got the '08 crisis lends great lessons. It basically proves out the Austrian theory of the business cycle, and it really shows, or it really demonstrates errors in issues with other explanations from other economic schools of thought.
And Mark Valek here, any thoughts on applying the Austrian school to the financial crisis and where we're potentially heading today in the global economy?
Definitely some thoughts. Very short though, because again, a lot has been said already. Where are we going in the global economy? I mean, providing you have this Austrian set think of perspective, the Austrian perspective, as we all obviously have it, you actually know that there are significantly highly destructions now to the capital structure, and this is not a sustainable state. So you can assume that sooner or later, but there lies the problem for investing, obviously, the timing question, but sooner or later, this state of capital structure will not last. It's absolutely not sustainable. Just on a side note, as an asset manager, I encounter sustainability so many times a year. It's kind of inflated word. Everybody wants to invest sustainable. What bugs me about that is nobody thinks about if our, for instance, monetary system is sustainable, and I would argue against it. So this is, to me, really a very superstitious discussion here. Superficial, sorry. However, I think if this cleansing process starts the next time, we will probably will not see the big fear which we saw the last time, which was basically the fear of deflation, of debt deflation, if you want to call it like that. I think the authorities have proven that they just will not let this happen. So market participants probably are not going to have fear that there will be too little money going around or being printed, but perhaps will start to fear that this is going to be an overdose the next time. And I think as soon as this psychology changes, you're in an all new ball game then, and things like price inflation look much more realistic in such an environment, if you ask me.
That's great insight. And so, given this view of applying the Austrian school to the economics environment, if we can consider that as far as the investment environment, does it make sense to look at the principles of the Austrian school in investing? I mean, we see some of the principles as being stores of value, indirect exchange method, meaning exchanging fiat currency for investments that are real assets that provide cash flows, investments with little or no debt, high free discounted cash flows as well, little or no leverage, also scarcity in innovative industries, and then perhaps cryptocurrencies that are outside of the banking system but still regulated within the financial system. So, does it make sense to apply those principles in investing? And what are those principles? Also, are there any empirical studies or analysis which indicate that taking this approach can provide an edge or an enhanced investment management performance? Just this question for the floor.
Well, this is Bill. I can say that I think knowing the Austrian business cycle theory is helpful. Back during the second bubble, the credit bubble, I wrote an article with a colleague called Collateral Damage. And what was fascinating about writing the article was we had created the Bearing Credit Bubble Index back in 2004 when it was pretty obvious that we were segueing to this new bubble. And, I kept looking at the types of asset-backed securities that were being created mainly in the mortgage arena in the U.S., and then the derivatives wrapped around it, and then attended a few conferences, but started focusing on the collateral because it's a confidence game, right? I mean, people have confidence once these bubbles start to grow. And what was interesting was in 2005, the home builders had started declining severely and writing down land values, et cetera. But subsequent to that, you had maybe, 12 to 18 months of just watching paint dry. I mean, the other, related industries kind of kept chugging along. And it wasn't until early 2007 where, the secondary market for certain types of mortgage-backed securities just locked up. And that was the beginning of the end. So to me, when I look at excess credit creation, through the socialization of credit by the central bank and or other government agencies like Fannie and Freddie in the U.S., I was looking at collateral. That was kind of a helpful sign that, we were near some kind of an inflection point. I think what makes this cycle so much more difficult, and look, full disclosure, I mean, we've had a net equity short bias for the last several years, and it's been pretty painful. I think this cycle, because they're all playing the same game, they're all in together. Is there any limit on what the central bank balance sheets could go to? I mean, how many bonds can the Central Bank of Japan or the ECB or the Fed purchase? And I think it's pretty clear that since all the chips are in the middle of the table, they're going to continue to buy bonds and try and hold, certain parts of the yield curve suppressed to keep the game going. So ultimately, I think, gold, we own a lot of gold. We've owned gold since 2002. I think gold will continue to act well and may become one of the best performing asset classes over the next several years until we either get some kind of a crack up boom or something close to it. So that's how it's helped us and how we kind of employ it in day-to-day portfolio management.
This is Chris. I'll say that I'm not sure if Austrian economic principles are necessarily applicable to investing, but Austrian economic conclusions certainly are. And they certainly are as they relate to the macroeconomic phenomena of recessions and inflation, because these are the two forces that create the greatest risk factors for anyone's investment portfolio. Recessions are going to pop any bubbles that are out there, especially in the equity markets. Inflation will destroy the bond markets. And when you're looking at equities and bonds, these obviously make up, for most people, the vast majority of their investment portfolio, or at least the core of the investment portfolio. So if you're able to use Austrian economics to navigate these two risk factors, I think it presents a tremendous advantage for investing. As far as whether or not there's been empirical evidence demonstrating this, not to my knowledge. I think it would be difficult to construct such a study for a couple reasons. One being the time period that we're looking at, because there haven't been, the Austrian economics has been utilized in this form, I think, for very long. And secondly, would be the sheer number of people using Austrian economics in this fashion. It's a very limited set. The people you have on the call, you know, if they don't represent a good portion of that universe, may be the universe of people managing money with Austrian economic concepts in mind. So it's a very limited data points out there.
Yeah, and this is Mark. I would sort of follow up on Chris's comments too. I tend to be also somewhat skeptical as far as if there can you look at Austrian economics as like instrumental tools for specific kinds of investment analysis or recommendations, and I think that's a harder thing to make a case for. What I think is incredibly valuable is how do you explain reality? And in essence, the kind of the largest school out there in terms of money management is the efficient markets theory. This idea that whatever the price of a given asset is at any time, it's the quote right asset because all the information is being priced in. So trying to outguess the market is sort of a fool's errand, basically. And I think that one of the perhaps the most basic, the most essential insight of Austrian economics is this idea of subjectivism, and that prices are wholly derived by human beings. And one of the other schools of economic thinking that I think dovetails nicely with the Austrian school is economic behavioralism. This idea that individuals are driven by greed and fear, and as a result, and this feeds very much into the boom-bust cycle of sort of the Austrian framework, that you get these ridiculous, unexplainable run-ups that lead to catastrophic losses. And if investors can simply, instead of, and I remember reading one of the most tortured treatments by Burton Malkiel, who wrote this seminal Random Walk Down Wall Street, which is sort of like the Bible of efficient market theory. And soon after the edition following the 1987 stock market crash, where the Dow went down 20% in a day, he attempted to try to explain how this was a rational response to changing monetary conditions, and that the market was kind of correctly pricing things all the way along. And you find these things, which I think Chris mentioned earlier. Simply, the Keynesians and the people who look at kind of classical economics, efficient market theory, they can't explain reality. But the power, the strength of Austrian economics is that you can see bubbles when they're coming. And like Bill, I've leaned into the defensive position unprofitably the last few years. So in the short run, you might seem to be looking like a fool. But if you can help your investors essentially avoid and maybe even profit from bubbles as they unwind, you're going to be far better off than the vast majority of the investors out there that are just being caught up and are losing 50% of their portfolio in multiple stretches.
Hey guys, it's Russell here. Mark, you've just made some really great points, and I think for me, I would echo a lot of what you've said. I think it's about creating a coherent perspective of macro reality. There's so many investment firms. You go onto their website and they talk about how they like to find mispriced assets because they believe that the market doesn't always efficiently price assets, but they've never really got a coherent reason why. And I think the nature of clusters of error, of boom and bust cycles of the business cycle creates a very, very coherent reason why you get big distortions and big mispricing. And what I try and do for my clients is I say to them that ultimately using Austrian principles is essentially about creating a coherent perspective of reality, and also using that coherent perspective of reality and juxtaposing it and comparing it to the narratives, the market narratives, I guess, with the capital N, that that emerge. Donald Trump gets elected, and there's a narrative that emerges, a reflationary narrative, or a narrative might be that he's going to deregulate, and the market, finds an excuse to run even higher. And you've got to kind of test all these market narratives against really sound perspectives of reality. In addition to that, I'd say a few things. The one is that an Austrian perspective gives you an understanding that you're not in a free, unfettered market. You're in a market where the state plays an incredibly dominant role and is essentially trying to plunder private resources. And so a huge element of investment strategy from an Austrian perspective has to be a defensive one. You are defending your wealth against the plunderers. The second component is that business opportunities can be false, and that's something that's embodied in the essence of boom bust cycles, subsidization, and Say's law, the principles of Say's law. Expecting consumer markets to boom when in fact you've got misallocated productive capital. Those consumer markets are not going to perform like you expect. But the flip side of that, of course, is that you get overestimated business risk, because some people are avoiding sectors that look unattractive when in actual fact they're fundamentally attractive, particularly if they can exploit state failure. And then finally, Hayek spoke about the pretense of knowledge in his famous Nobel acceptance speech. And one of the things is that none of us, whether you're an Austrian or not, none of us have the entirety of knowledge that we need to make very, very precise and accurate calls about the investment world. And that's one of the reasons why, and it's spoken about in the book Austrian School for Investors. But you've got to start off by exploiting opportunities as an investor that are close to you. That your knowledge is that you're capable of having knowledge about, and that's why before you invest in public companies and in funds, you've probably got to invest in yourself, in your own entrepreneurship, or in private equity opportunities that are very close to you and where you have some special knowledge, because you don't have any more knowledge than the central planners do either. So I think those are some really key objectives. I think there's some ethical issues as well, but I don't want to go into that right now. But I do think that when we talk about Austrian economics being a value-free, free of value judgments, that's very much in the theoretical, analytical sense. But once you've derived conclusions from that, value judgments definitely come to the fore. And I think there's a strong ethical component that can be informed across a range of asset classes and how you invest and how you go about investing. I'm going to not go into that right now. We could maybe circle back to that a bit later.
And Mark Valek, as Russ mentions, refers to your co-authored book on the Austrian School for Investors. Can you provide some insight from that book on these principles? Yep.
Yeah, thanks. I mean, also from my side, just a small supplement here. We thought about this topic very, very hard, I think, and we also thought, where would potential opportunities lie in Austrian investing, if there is such a thing at all? But where also do potential risks lie in such a discipline? Just a few words on opportunities. We heard, I think, already thoughts in this direction. But for instance, the fact that it's not spread among investors, I think that's potentially a huge edge. It's a huge edge in a marketplace where you have it's not even secret knowledge. I mean, it's out there. You just have to read it in the internet. Go on Mises.org or wherever. But most of the people just don't care, just don't know about it. So it's not spread. Second edge, knowledge about Austrian business cycle theory, we also talked about, but I just want to point out a third edge, which we identified, and I think that's a practical edge, actually. I think Austrians in general are able to understand alternative currencies much better, i.e. they are able to think about outside of the fiat money system. Just as we all think so much about the current system, that helps us. For instance, when Bitcoin or cryptocurrency came up, I was not even as a tech guy, but just from my Austrian view, I think pretty fast able to wrap my head around the basic concepts. And I knew if this thing monetizes, then it has huge potential gain, and if it doesn't, well, it's until it does, it's a speculation on a potential alternative money. I mean, by now I think this is more clear to the average investor too, but such things I think come with an Austrian mindset. On the other hand, just also to talk about the risks perhaps for one moment, which are associated with Austrian investing. Generally, and I'm sure all of us know about this potential risk, is a bearish bias is associated to the typical Austrians. I think that comes also because Austrian investors are sensitive to these flaws in the capital structure we already talked about, and you always kind of think perhaps this boom will end in a bust sooner than later, and so on, and we know the problems I think associated to that. Another problem I also touched already is the Austrian school specifically does not make timing calls. So this is for a practitioner a problem, obviously, especially in finance. I think one can circumvent this problem with the help of other just like other techniques from the quantitative side, technical analysis, whatever. But strictly speaking, from the Austrian school, you don't get any help regarding the timing problem. Just to mention a last potential risk, also Austrians do tend to be very convinced it's like what we call potentially a dogmatic bias. And dogmatism is probably a thing where one should be cautious in the investment space. So there are a lot of opportunities, but there are also risks, and one should be aware of these risks and find some ways to manage these risks as an Austrian investor.
If we can do one more round on bringing it all together and providing some examples of investments or asset classes, or perhaps investment strategies that exemplify using the principles of the Austrian school in investing, or the outcomes, as Chris mentioned, of the Austrian school. Let's do a round based on that to close out. No specific companies or securities, but just generically speaking. Anybody?
It's Russell. Yeah, maybe I could just come in and say one or two things about some of the ethics around investing. I mean, we clearly all have to make a decision about leverage in a system that is where debt is certainly where it's created by fractional reserve banks is problematic. We understand that the core of business cycle problems and of creating debt liabilities without prior savings is a systemic problem. And of course, when you participate in that system, I mean, there's two ways you can look at that. You either participating in the bank leverage system as a defense mechanism against that system, but you could also argue that you're aiding and abetting that system. So I think every investor has to answer some pretty tough questions about leverage and about the kind of leverage. And that's, of course, where I think from an Austrian perspective, you would typically favor equity over debt, and you would favor non-bank debt over bank debt. The other big ethical question, of course, is to talk about government bonds financing the state. The state is essentially a mechanism of wealth destruction. Do you really want to be financing that government? Again, you could look at it in two ways. In one sense, it's a defensive mechanism against plunder, but in another sense, by funding the state, you're again aiding and abetting, a fairly large degree of wealth destruction, and ultimately are getting your coupon payments in part by being taxed more and your friends and family being taxed more. So one's got to think about, I think, some of these issues. And then we know that Ludwig von Mises was one of the greatest advocates for peace and anti-war. And you have to think about, what firms are doing in terms of financing and funding and equipping governments to fight unjust wars. These are obviously very tricky and murky, and I'm not trying to make any kind of highbrow ethical statements here. I just think that these are all things that have to, these are the kinds of things that have to be considered, and Austrians do think a lot about these things. So I just wanted to kind of lay that out there, because ethics and feeling good about, feeling personally good about your investments, not just intellectually, but emotionally as well, I think is an important part of an investment strategy.
And this is Bill, I'd like to just touch on something Russell mentioned. I think it's great points, by the way. The state has grown immensely around the world subsequent to 2009. And I don't want to get too far into the metrics. We all know what's played out in certain parts of the world. I think one of the beauties of the internet and the search for the truth and leading up to the election in the United States, for example, last year in WikiLeaks, the internet is essentially exposing a lot of the fiction that we've all grown up around over the last number of decades. And with that comes almost an awakening, a move to higher consciousness. And so people are, I see it every day. I think people are leaving tax-free bonds or government bonds and doing other things with their capital, getting involved in private local businesses. I don't want to get too far off track, but I think that is something clearly playing out. Cryptocurrencies, I've spent a lot of time looking at the economic actors within this interesting ecosystem. And if you think about, not being a participant in the plunder, if you look at just the banking system and all the friction within the banking system, let alone the leverage, you're looking at a couple $2 trillion a year just in general friction that's being stripped out of the ecosystem. So the movement towards the internet of value, as opposed to what we witnessed the last couple of decades, the internet of information, knowledge, I think is another fascinating innovation playing out. So I think more and more people, to Russell's point, don't want to participate in the plunder and are actually spending time and capital, creating these new economic fabrics. And I think it's quite exciting to witness.
This is Chris. If we take out the ethical considerations that a couple of my colleagues just mentioned, the question is, how does Austrian economics help you when looking at investments from a risk-return standpoint? And I think Mark mentioned this earlier. Hopefully I'm not misinterpreting him, but I believe Mark made a point that Austrian economics doesn't help us analyze any particular investment vehicle or perhaps even investment asset class. And by that, I mean, just because a company has more or less debt than another company doesn't make it more or less Austrian, or just because a company operates in such and such an industry doesn't make it more or less Austrian. The Austrian economics helps us because of the explanations as to inflation and recession. It helps us protect portfolios. It helps us minimize risk. It also helps us profit from developments, macroeconomic developments, when they occur, primarily meaning any kind of pops and bubbles or bond markets, whether stock or bond markets. And so there you want to look for investments that will do well in that context, or that will weather the storm, so to speak, and do well regardless as to what happens. So you want to consider industries that potentially have high growth, that will not be negatively impacted, or at least will not shrink or be reduced in size from the effects of inflation or recession. So maybe in America, you want to consider the cannabis space. Maybe you want to look at investments that historically have done well when you have inflation, meaning you want to consider gold, you want to consider farmland, things like that. So I think Austrian economics, again, helps us from an investment portfolio standpoint, minimize risk, and really seize on some great opportunities as these things transpire. But as far as analyzing any particular asset or asset class, I don't think they lend that much value. I'll also say that I think Austrian economics lends itself naturally to contrarian investing, which I think is a great way to make money. It's pretty obvious that there's not a lot of people out there managing money that believe in Austrian economics. So we hold a key. We understand something that few people embrace or have any kind of knowledge of. And I think that really is a key factor in contrarian investing, which really just means you're looking for extreme market valuations on the high or low side and identifying the catalyst that will bring the prices back to their historical mean or median. And I think the explanation in the conclusions of Austrian economics do that quite well.
So this is Mark Whitmore. I keep forgetting we have two Marks on the line here. And Chris, I definitely, you absolutely interpreted what I was trying to say correctly. And kind of to follow up a little bit, I think one of the things that the other Mark pointed out is the issue of timing. And whereas kind of the two prevailing investing paradigms out there seem to be this notion of efficient markets theory, which attempts to just buy and hold the market no matter what, completely price indifferent. And that's really key, is that Austrians, I think, have a sense of value in the marketplace naturally. And it doesn't come from any unique insight of the Austrian school, other than the fact that the combination of this subjectivism coupled with the inherent boom-bust cycle makes those of us who use Austrian economics very sensitive to issues of price and value movements. I mean, I think that, a cynic is oftentimes defined as somebody who knows the price of everything and the value of nothing. And I feel like Austrians are exactly the opposite, is whereas other investors are chasing price action. If you're somebody who's sort of a trend follower, or you're simply buying and holding, there's a greater tendency to appreciate value. And this point dovetails with the other point, as far as, since we don't pretend to know the precise timing of when bubbles kind of unwind, or when the busts will finally reach a bottom, the idea is that we can essentially be in sort of like the right quartile of activity. In other words, I never try to catch the very top of a bubble. I don't try to ride things to the very end. And similarly, I don't mind catching falling knives, because as investors, if you're looking at this current contemporary global macroeconomic backdrop from a 10 to 12 year perspective, I find it, with the typical disclosure here, that I'm not able to see with a perfect crystal ball and everything, but it's hard to believe that traditional assets, that global equities will be thriving in this environment, just from a simple perspective of how overstretched they are from any reasonable measure of valuation. And similarly, the global bond market, which has been the classic offset to unwinding stocks in the past, is also so stretched, because just like bond prices are inversely related to interest rates, you have interest rates around the world. I mean, you have negative interest rates in Sweden, in Japan, in Switzerland, and back last July, you had negative interest rates over a swath of different developed markets. So there's simply not a lot of room, basically, for bond appreciation. I think it's a very, very perilous time for equity and bond investors from a kind of a longer term perspective, whereas those of us who are Austrian have a bent for the idea of sort of real money, sound money. And one of the things that looks pretty attractive in a Ponzi finance global macroeconomic backdrop would be precious metals, I would say. And I particularly play in the currency space. And one of the things that's attractive there is the idea that in eras where you have reckless central banking, there's huge distinctions between reckless central bankers and those who are engaged in reckless central banking with abandon. And as a result, I think that there becomes some real value disparities from a currency standpoint as well. But I think that's how I at least kind of use economic principles from the Austrian school to inform overall investing decisions in the marketplace.
And finally, the other Mark?
Yeah, I think most of the points have been touched seriously. I just don't want to drag it out unnecessarily, but I think there were very interesting comments in all kind of directions. Really enjoying this discussion. I don't know if we have anything else on the plate still.
No, that's it. Just wanted to close out with regard to giving everybody a chance to identify how our listeners can learn more about your work. If you have a website or perhaps a newsletter.
Yeah, that's right. So yes, so my website, ETM Macro Advisors website is etmmacro.com, and I am starting a new newsletter called The Macro Outsider, and you can sign up for it for free at etmmacro.com. And you'll get a free essay called The Real Currency War, which is subtitled Monopoly Money versus Real Money. And essentially there I just go into a lot of what we've spoken about today in terms of, chronic malinvestment, the weakness of, fiat currency reserve systems, and then ultimately where I think the real currency war is, which is in centralized versus decentralized money. And I talk a little bit about cryptocurrency there as well. So that's etmmacro.com. You can sign up for that free newsletter.
This is Bill. So Kevin, Duffy, and I, we manage a couple of funds, long-short bias, I should say long-short strategy, macro-oriented funds, bearing asset, like ball bearing.com, and then we also write a blog, bearingasset.com/blog. And then Kevin and I are on Twitter as well. We post some comments from time to time.
Great.
Yeah, and this is. Oh, go ahead, Chris, please.
Sure. This is Chris Casey with Windrock Wealth Management. We manage money for high net worth individuals. I would encourage anyone that wanted to check us out just to visit our website, windrockwealth.com. And besides having contact information there, we have all of our content, meaning podcasts, articles, blogs, etc., that have been posted since we started the firm, and people can feel free to read more about our philosophy on various issues.
Great.
And this is Mark Whitmore in Seattle. I have a website at whitmorecapitalmanagement.com. There's a research and articles section, which has, I do a quarterly newsletter, and would be happy to put anyone interested on the mailing list for that. And basically, we have a strategic currency fund that, again, is informed largely by Austrian economic principles that I operate. I also will make a plug here for one of my co-panelists, Mark Ballack, who is about to say something, but his book, Austrian School for Investors, is essentially basically, that he co-authored, is one of the only kind of resources out there, and it's an outstanding resource and really well researched and thought out. So I want to compliment the fine work he's done on that.
Great. And
thanks so much. Thanks. Thank you. If you're interested, book is on Amazon, I guess, Austrian School for Investors. Our homepage is incrementum.li. Incrementum spelled with a C. We've got most of the stuff which is relevant up there. 1st of June, our annual Ingold Trust report is going to be published as well. You'll find it on that homepage as well.
The FRA Roundtable Insight Show is for informational and educational purposes only, and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.